Let's start with two key concepts in trading: support and resistance. Think of support as the market's floor, a price level where buyers step in and stop prices from falling further. When price nears support, demand increases, often causing a bounce. Resistance is the ceiling, a level where sellers emerge, halting price advances. As price approaches resistance, supply overtakes demand, and prices often reverse downward. These levels matter because they help you spot where price might turn, letting you plan trades more effectively. Traders often buy near support and sell near resistance, using these levels to set entries, stop losses, and profit targets. Support and resistance provide structure to the market's movements. They're rooted in market psychology. Traders remember where price reversed before and act accordingly. This collective memory creates self-fulfilling floors and ceilings. When you see price bounce repeatedly at a level, you know others are watching it too. These levels become powerful tools if you know how to use them. But remember, they're not magic. They're just areas where buyers or sellers have acted strongly in the past. Understanding support and resistance is your first step to reading charts like a pro. Use them as a roadmap, not a guarantee. The more times a level is tested, the more significant it becomes. Mastering these basics gives you a real edge in the markets. You might think, great, I'll just buy at support and sell at resistance. But it's not that simple. These levels can and do break, especially in strong trends. In a powerful uptrend, resistance can be shattered as buyers overwhelm sellers. In a strong downtrend, support can collapse, trapping buyers in losing trades. This is called a breakout or breakdown, and it's a common trap for new traders. Acting on support or resistance alone without context is risky. The overall trend can overpower these levels, leading to unexpected losses. That's why you need more than just horizontal lines on your chart. Support and resistance show where price might react, but not if it will. Trading them blindly is like guessing. You need confirmation, something to tell you if the level is likely to hold or break. Context is everything. Let's add a tool that helps you avoid these traps and trade with the trend. To avoid false signals at support and resistance, you need to know the market's trend. Enter the moving average, a simple, powerful indicator. A moving average calculates the average price over a set period, smoothing out price action. When price is above the moving average, the market's in an uptrend. Below it, a downtrend. The 50-period and 200-period moving averages are popular for spotting trends. Moving averages can act as dynamic support or resistance, adapting as price moves. In an uptrend, price often bounces off the moving average. In a downtrend, it gets rejected. Combining moving averages with support and resistance gives you a clearer market picture. The moving average shows trend direction. Support and resistance show where price might react. This combo helps you avoid fighting the trend and improves your trade timing. Use the moving average as your trend filter before acting on support or resistance. Let's put it all together into a simple trading strategy. In a downtrend, price is below the 50-period moving average and approaches support. Don't buy just because price hits support, wait for confirmation. Only consider buying if price breaks above the moving average and holds there for a few candles. This signals buyers are regaining control and support is likely to hold. In an uptrend, price is above the moving average and nears resistance. Don't sell just because price hits resistance, wait for confirmation. Only consider selling if price drops below the moving average and stays there for a few candles. This shows sellers are taking over and resistance may hold. Patience is key. Wait for price to confirm a shift in control before trading. This approach keeps you on the right side of the trend and avoids common traps. Use the moving average as your green light for action. Support and resistance tell you where. The moving average tells you when. Stick to this rule-based method for higher probability trades. Let the market prove itself before you commit. Here's what you need to remember. Support and resistance show where price might react, but not when to trade. The moving average is your trend filter. Trade with it, not against it. Never assume a level will hold. Always wait for confirmation. In a downtrend, only buy at support if price breaks above the moving average. In an uptrend, only sell at resistance if price drops below the moving average. This simple rule keeps you patient and disciplined. Patience and confirmation separate successful traders from the rest. Master these habits and you'll trade smarter, not harder. Let the market show you the way, then act with confidence.